YouTube. Got a nice little snowstorm going on outside, so hopefully the internet is going good. Right as I said, I get a warning, dropped frames detected. Your stream quality may be poor. I don't even know what that means. But it's 10 after 4, so let's get it started. I am associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. We got the position disclosure right here. I don't know about you guys, but I was dumping stock into the close. Did not short yet. Would love a gap up tomorrow, in which case I would consider shorting. Okay. Let's get into it. Actually, hold on. Sometimes my charts get a little bit cut off on the YouTube, so let's do it like this. All right. So, how did we close today? The SPYs here closed up 1.6%. NASDAQ is up 3%. Solid. And even the lagging Russell's up 2.6% on the day today. Pat had just posted right here after the close some monthly numbers, which I will read out loud. The Dow notched its largest January percentage drop since 2016. The S&P had its biggest January drop since 2009. I know at one point the NASDAQ was set for its worst month, I think, in history. Its worst month ever. And then obviously we had this really strong snapback Friday into today that helped to negate that a little bit. I thought Pat had some monthly percentage numbers on here too, but I lost them. Oh well. Anyway, yeah, I'm pretty sure at one point we were set for NASDAQ's worst January in history, and I'm assuming that's not going to be the case now with the I'm still having a couple tech issues. Sorry, I'm getting distracted by some of your guys' comments. I'm still having a couple of tech issues with the getting my video camera to do both the YouTube and the VTF at the same time. But the charts are there, and as much as I know you guys like looking at my handsome face, the charts are what's most important, right? Anyway, like I was saying, NASDAQ at one point was set for its worst January in history. Huge snapback over the course of the last couple of days. Another 3% onto the Qs today. I know we didn't do an afternoon meeting on Friday, so that's worth chatting about a little bit too. We came into Friday. Friday was such an interesting trading session, right? Because we initially traded lower, and then we finally caught that bid. This is Friday's price action, right? We initially traded lower. The futures were all over the place that night. We initially traded lower. We started our bounce, and we really had that rip into the close. We had wanted to see if Apple could save the day. Apple's earnings report was stellar. Apple was up 7% on Friday, and it was up another 2.4% today. So it's a hectic snapback from Apple, which really helped to save the marketplace just because Apple's the biggest company in the world, and it is a very large percentage of the S&P and the NASDAQ. I think it's like, 7% of the S&P and 12% of the NASDAQ. So, move like this, where we're going up almost 10% in 2 trading sessions for Apple, is going to have a hugely positive effect on the S&P and the NASDAQ as a whole. But it wasn't just that. I actually did a video about this one that hopefully will get posted on the Derek the Trader YouTube soon. But it was also this Robinhood. We spoke about, I didn't necessarily expect Robinhood to fall through to $14 from 10 on Friday morning when we were talking about it. But I remember into the VTF pre-market Friday before our morning meeting, I called out a trade in Hood back through $10, and I just mentioned in the meeting, like, if this Robinhood can actually trade well and it can, let alone close green, it could really be a signal for these growth names in the market. And I'll tell you why that is. And again, I did a little video on it, so hopefully we'll get it on Derek the Trader soon. What's been the deal with these growth stocks? When growth stocks are not delivering on their earnings numbers, specifically on their guidance numbers, they have been getting absolutely destroyed. Like, destroyed. The market has had no sympathy at all for growth stocks missing numbers in a potentially rising interest rate environment. We've seen, gap downs of 15 to 30% on bad earnings reports for some of these growth stocks. And then this Robinhood reports these numbers on Friday morning that were atrocious. They missed on EPS, they missed on revenue. Their revenue guidance for Q1 was off by like almost $100 million. It was awful. So stock was set to gap down 18%, or did gap down like 18%, and then had almost a 30% intraday rally to close green on the day. And this is a good lesson for new traders too, because every once in a while I'll get a new trader who just thinks that if a company beats on earnings that they can buy it, and if a company misses on earnings that they should be short. And I tell new traders all the time, every single earnings season you're going to see at least a couple of companies that beat on earnings, beat on revenue, guide really well, and go down. And you're going to see the opposite happen sometimes also. And that's what happened here. But it's particularly interesting that Robinhood could do this because it's a growth company, and growth companies have been getting obliterated. Forget about Robinhood's bubble, where it went up to $85 here. Just talking about the IPO price. The IPO price for Robinhood was $38. 38 bucks down to 10. It's like a 70-something% decrease in the stock just from the IPO price of 38 bucks. Again, forget about $85. So at a certain point, and this is the root of technical analysis, supply and demand, at a certain point in a decline like this, you just reach a point where anybody who is going to sell Robinhood is going to sell it. If you're bag holding at $10 still as an investor, you're probably with this thing to the death at that point. You're not. If you didn't sell by the down move to $10, you're probably not selling. And same thing with the shorts, right? The shorts are just coming in, and the more the thing goes down, probably the more shorts are going to be in it. And then we saw that news kind of hit during the day on Friday in the VTF that Interactive Brokers ran out of stock to short for Robinhood, and it was just a whole extra signal there. So at the end of the day, it's all supply and demand. It's all technical analysis, because now you got a growth company here that just reported the worst stinking numbers. They were not good, and then stage a rally now from $10 to $14 over the course of just a couple of days here. It's up another 10% today at the close. So really sick move, and that obviously boded well for the entire market. Apple's earnings, and then seeing the growth names be able to hold a little bit like that. So SPYs, Qs, to a lesser degree the IWM, staged a really good rally on Friday. We closed like really strong. The rally into the close on Friday was great. And I remember coming onto the VTF radio on Friday into the close, and me and Pat were both on there. And I was like, Pat, what do you think about this close here, right? And he was, saying what we already know, which is that bear market rallies can be strong and they can be vicious. And technically, we did not, as of Friday's close, break the bear flag to the upside. When you break a bear flag to the upside, there's a common saying in technical analysis, and it's a common saying for a reason. From a failed move comes a fast move. So you have a failed bearish pattern because it breaks up. You get a very fast move to the upside. So it's like, Pat, what do you think, this bear market rally, what could that lead to as far as a move goes? And he said, 450. And I said, spot on, that's what I'm thinking too. Why 450? Because 450 is the previous support that we broke down from. We know that previous support acts as future resistance. And the declining 21 EMA is working its way down to that 450 as well. So you're coinciding previous support that can act as future resistance with the upper band of equilibrium. It would be a very hard snapback. I mean, look, we were just Friday morning at our lows, we were at 427 and change for us to get to 450 today. It's just a sick up move from lows over the course of those 2 days. And, we got exactly back to our price target of this oversold bounce, which is that 450. The question is what happens now, right? What happens now gets a little bit trickier. For bears, potential lower high. And we do still have time frame continuity to the downside for the most part, right? Our small time frame and our intermediate time frame and the daily chart are definitely trending down. You still can make the argument at the big time frame that 200-day simple moving average is still sloping higher. You can still make the argument that the very big time frame for the S&P is still in an uptrend. But if you look at like the IWM's got that pure time frame continuity to the downside. And IWM's been so disgustingly relatively weak, still pretty far away from its 21 EMA, is still not even above the highs from Wednesday, from the high from that Fed day. But for the SPYs and the Qs, it's a pretty strong snapback, almost to that upper band of equilibrium. And again, the SPYs got perfectly back to our price target. In bear markets, or bearish markets, it's incorrect to call the SPYs a bear market. The Russell you definitely can call a bear market, but I would call it a bearish market, time frame continuity to the downside for the most part. The biggest updates in the history of markets are all, for the most part, in bear or bearish markets. So seeing these really strong rebounds is great, but it's not necessarily an all clear sign. The big question is, are the bears going to come in and are they going to put in a lower high? And the answer to that is probably more probable, right? So I know for myself, I didn't start pulling the trigger on any shorts here, but into the close, I was dumping stock. I was really dumping stock into the close because we got right back to our price target. It's a huge up move in a couple of days, and now we'll see. If we could get like a big gap, so I said this into the VTF right into the close. I was like, at this point, I want a really strong 450 close plus a gap up tomorrow. If we could gap up to like 452 tomorrow, like a $2 gap up, $2.50 gap up, you got to start looking for shorts at like 9:45 a.m. tomorrow, I think, or at least your technical signal to start putting in some shorts into a gap up tomorrow. It would just be such a big move, plus a common gap to the upside. We'd almost would be coming extended to the upside. I would almost assume that on like a gap up tomorrow, like the short-term sentiment indicator would actually be in the sell zone, which is just crazy. It shows you how big the ranges are and how fast that can flip. But for now, no new positions, no new shorts, but definitely took off a lot of longs into the close. And today was a great trading session for us because we had, first of all, this is really what we were expecting. I know it was a little bit of a tricky open because we were opening right at the 80 MA on the daily chart, and we were opening up right at resistance of the daily chart as well, resistance of this bear flag. But it wasn't our expectations to see some bear market rally continuation. So we had a good bit of long setups coming into today, and pretty much they were really working for the most part. I wanted to try to find ones that were coinciding with upgrades, just in case the market wasn't as helpful as I thought it would be. But I had some that had news, positive news, and I also had some that just had good technical setups. So CHPT was one of them. We called out a long versus yesterday's high. I know a lot of you guys caught this trade, which is fantastic. So you got an inside and up here with an upgrade. There's been kind of consistent upgrades coming in from this one. It broke this pivot high. So we spoke about, an initial move maybe to 14, or a bigger move could even work its way up to more like 14.50 to $15 is where the next kind of resistance is. So I think some of you guys are swinging it, which is great. I love being greedy when your risk is totally covered. You're swinging smaller percentages of your position because you do recognize that it's counter trend, and we have time frame continuity to the downside for both the market and for this stock. But keeping a little bit just in case you get follow through to $15 in this thing, I think is reasonable and prudent. So fantastic job for people who are in that. What else was on the list this morning? I was talking about this Invisalign. I know Viral had told us that there was a short report near highs at one point on this thing as well. But this thing got a solid upgrade. I liked that this put in a higher low versus Monday a week ago's low. So that was a little bit of a sign of relative strength as opposed to like the IWM type stocks, which had put in new lower lows still on Friday. Certain stocks like in the SPYs did not, and this was another one. So if anybody was able to capture that, it was a really nice move. Kind of an expensive stock, so you definitely needed to be a little bit careful there. What did ISRG do? I know that was on my list today too, and I took it off. Yeah, ISRG into that gap we spoke about in the morning meeting. That one worked out really well. That one also had a nice upgrade. Stocks without catalyst that were on the list today. NEO for a snapback off the hammer. I had actually tried this NEO and got stopped out on Friday back through $20. I was just a little bit too early on. I had 3 snapback trades for Friday. One of them worked perfectly, and the other 2 were more difficult. NEO was the only one I tried, and I got stopped out. We talked about AMD back through 100. That one was also a little bit tricky, and we had spoken about Tesla back through 800, which that one worked out really phenomenally well. Spoke about Beyond Meat this morning. This one I think also had an upgrade. I didn't love the lack of volume confirmation on the hammer. I didn't love the lower low, but I did like the upgrades. That one kind of was on the list. I think a couple of you guys caught that, which is fantastic. I had Snap and Twitter on the list for today. Snap for a break of 30.50. That one worked out really well. I'm not really sure if anybody took that one, but I know at least ET and I think maybe a couple of the other guys took Twitter, which was also an idea I had through 35.50 resistance break today. That one worked out really well. So, I think that the team just gets a great pat on the back today. We weren't trying to fight this rally. As a matter of fact, we were participating in this rally. We recognized the probability of getting a further snapback and where that could lead to. It literally went exactly to our price target on the SPYs. Like every single idea for the most part that we had on the list from the morning meeting today worked. A lot of traders participated in it. A lot of guys put up really good P&L. So it's fantastic. I love it. I absolutely love it. And again, now though, we get trickier. So we'll see if the bears can give us the next lower high of the downtrend. And for bulls, we're certainly in an environment where ranges get exaggerated. And I know personally sometimes that can be actually too shallow in my price targets when the ranges get this big. So maybe we do see further upside. Maybe we do see a further snapback to 455 or something like that. Even 457.50 I think could be reasonable. And a really big snap before bears kind of attempt to regain control. So we'll pay attention to where that happens. But at some point soon, you would think that these bears are going to try to create a lower high for the market. And what bulls would really want to do is create a wedge. So wherever that lower high kind of comes in for the marketplace, whether it's right here at 450 or that snapback's a little bit higher, another $5-7, wherever that lower high comes in, the bears want to create a higher low. And if they can create that wedge type pattern, that would kind of create more of an uncertainty pattern here where you'd have different time frames telling you different things. It would be a very neutral pattern. But if the bears could create, it's a longer process, I think, for the bears to break higher here than just having a V-bottom, even though we did see V-bottoms in 2018 and 2020. I think that the better move here, if bulls are going to be able to regain control, is going to be through a trend reversal process where a lot of times a wedge would actually come in order for that to occur. Again, not predicting it, just kind of laying out some scenarios here for bears and bulls, and we'll take it as it comes. Without a doubt, though, starting tomorrow morning, I think that the price action becomes a little bit trickier as we get into this upper band of equilibrium and as we get into higher degrees of the oversold snapback that we had been looking for. So, definitely a really good couple of days here. And Friday, too. I know Felipe, again, congratulations, Felipe, for posting your best day ever on Friday. Fantastic job for that. It's awesome when, a really strong member of the team can post up some super beastie P&L like I know you did. So it's just a great couple of days here, but don't fully count your chickens yet. Look at me, I'm in Idaho and I'm talking about chickens. Don't fully count your chickens or your cows or your llamas yet until we get a little more confirmation. The bulls would have a lot of work to do to really still continue to kind of turn this thing around. And I'd be surprised. I'm not seeing any type of V bottom come in for this market. So that's all I got. Happy to answer any questions. First here from Chinggis. Does the generational change affect money flow? Have you seen anything similar in your career? Like the change in the way what smart money thinks and does due to generational change. So no, I've never really experienced, I don't think, what would be called a generational change in regards to markets. I assume that what you're talking about here is, all the baby boomers retiring, and in theory they should or will be continuing to pull money out of the markets just to live in their retirement, while you've got your millennials and Gen Zers entering the workforce and potentially starting to buy stocks, and it does seem to me so far, maybe I'm wrong, that the average kind of millennial Gen Z person, and I know that they receive a lot of hate sometimes for things like their poor work ethic and things like that, but it does seem like broadly they're a little bit more educated of an investor than maybe like my parents' generation coming up. My parents were pretty smart people. They did okay. I'm saying that kind of broadly, so in case my dad's watching the stream, which I don't think he is. No insults thrown at him. But anyway, I really don't know. It's a very broad question, Chinggis. It's not really something that I'm overly concerned with. I've seen chatter for years now about how baby boomers pulling out money into retirement is going to have negative impacts on the market. It's not been something that I've really agreed with, and it's not been something that I've seen negatively impact the market. If anything, I think that the new normals are, people have their jobs with job benefits and IRAs and 401ks and things like that, and people aren't really actively trading their 401k. It's just money flow kind of constantly coming into the market consistently over time. So, not really something I'm overly concerned with. From Christian, today I messed up my CHPT trade. Oh man, I hate to hear it, but let's take a look and see how we can learn. Today I messed up my CHPT trade trying to add to my original position. Here's what I did. So first he bought at 13 versus 12.51, which is exactly what I think I spoke about in the morning meeting. You're only able to buy 200 shares because it's a lot of risk. When I saw the second bar was an inside bar and the ADMA had caught up to the low of the day, I thought I could buy another 200 shares at the break of the inside 5 versus lows. Okay, it looks like it would have worked perfectly. Versus the low of the inside bar. My idea was that summing up the dollar risk of the add plus the dollar risk of the original buy versus the new stop, I was risking my original $100. The problem is that I pressed the wrong key instead of adding. I liquidated my position for a tiny profit. Was my thought process correct? Okay, so this was just an execution problem. This wasn't that you traded it wrong. It was an execution problem. So I like your idea. So sum it up. So first of all, we spoke originally about CHPT. You could have used Friday's high, the inside day high of 1266. The pre-market low was 1251. So I remember mentioning you could use 1251 as an initial stop loss as well. $13 here is where the break occurs. And we oftentimes don't like to have our stop loss at the low until the ADMA catches up. So sometimes what I do is I'll have a looser stop, and as soon as the ADMA catches up to lows, I can bring it up to lows. So pretty quickly here, you would be able to bring your stop loss up to that 1272. But Christian here started small because he was originally giving it a lot of space, which is a great idea, and then wanted to be able to add as the setup came together. And the setup sure did come together. If you missed the $13 breakout, we communicated these 2 inside 5s, which we call a shooter, in real time as they were coming as a potential add. So you could have been buying the break of the third bar's high versus that bar's low. You also could have used a little bit of a looser stop if you wanted, but this is a nice, I love opening move, rest, continuation in a stock that got upgraded when the market's helping it. I mean, this chart, the opening of this chart was beautiful, and it gave people multiple opportunities to be able to get stock. So I think that your entire thought process was right. The way that you did it is right, kind of combining the risk there. You also could treat it as 2 separate trades. That's another thing that I would consider doing. You have your original risk from your original trade, and then you're taking a second trade just in the same stock based off the 2 inside 5 setups here, looking for that momentum continuation. So that's another way that you could do it. I'm not saying that one way is right and one way is wrong. I'm saying that there's 2 ways that you could do it that are both correct. I tend to do it that second way, where you're kind of taking 2 trades here and putting on the additional risk. But either way, it's the right thing. You can't, guys, and a couple people have done this recently. You can't get stopped out of a position, or sorry, I said that wrong. You can't keystroke out of a position and then just sit on your hands and be sad. If you accidentally press the wrong button and you accidentally liquidate your position, you need to rebuy your position right away. Your trade is still intact. The worst case situation is you're buying a couple cents worse, especially in a $13 stock. How much worse of a price are you going to get if you're super quick? You just pay what I've always called the idiot fee. And Christian, I'm not calling you an idiot. It's just the term that I've always used for when you make a mistake that we all occasionally make of pressing the wrong button. I just call it the idiot fee, which basically means, if there's a spread difference, a couple pennies difference, you're paying a little extra in commissions because you have to rebuy your stock. That fee is just the idiot fee because you shouldn't have pressed the wrong button to begin with. But you can't miss such a great trade that you executed properly because you accidentally hit the wrong button. You accidentally liquidate your position, take your stock back, and do it as fast as you can. The trade is still intact as long as you don't wait. Don't wait. Take your stock back. A couple cents extra worse, who cares? Take on the extra risk. Don't make the mistake next time. See you, Judy. Good job today. Let's see here. Gabriel had a question. What would be a good sign that the market is back to being healthy? Beating up spec names, being above the 200 SMA is a good sign. Yeah, seeing those stocks catch a bid is a good sign. I mean, but what would be a real sign that the market's back to being healthy would be the market getting back into neutral or bullish territory, right? One of the ways in which we always like to view our markets is in terms of bullish, bearish, neutral. Well, we are unequivocally in bearish territory even with the snapback. If we start getting a close above, part of me wants to say 450, part of me wants to say actually above this low, which is 456.60. But if we get a close above there, we would go back into neutral territory, and only if we get a full reversal would we be back in bullish territory. So I think that we're a ways away from being able to say that this market's back to being good and healthy. The market is going through a fundamental change, right? The idea here is interest rates are going up, but we need the strength of the economy to pick up for it. And there's a lot of debate around if the economy is strong enough to be able to pick up for those higher interest rates. So there's a lot of work that needs to be done here technically for the market before that could happen. We got to get back to bullish territory. We'd have to reverse back higher. We're ways away from that type of confirmation. From Justin here. Not sure if you knew, but it's useful info. The IWM hit its anchored VWAP from COVID lows on Friday. That VWAP is 188.13. That's interesting. That's interesting. And the SPYs and Qs never made it to their COVID low VWAP yet. I don't personally look at volume weighted average price in my own charts, but whenever someone else brings it up, it becomes a piece of information that I always pay attention to. So Justin, I appreciate you providing that information to us. What's $100 million between friends? Am I right, Greg? Yep, Robert's saying that the Beyond upgrade worked well. Also, it definitely did. ET is splitting a little bit of Twitter NCHPT that he caught today. I love it. Awesome job. Next here from Rich. I had 800 SoFi today. And I sold half to cover risk at 1160. I sold 200 at 1190. Okay, just this thing got pretty extended up here. That'll getting back above this $11.80 to $12 area is huge for SoFi. Technically, by the way, this could mean that they just shook out a ton of people below that kind of $12 support on Thursday, Friday last week. It still has a lot of work to do. It just closed. It only closed into the EDMA on the daily chart here for the first time. Really, this thing needs to get back above 13. You know what? I'm gonna say 1350. 1350 was that important inflection area after that news. So really, the SoFi needs to get above 1350. It'll also be above the 21 EMA if it can do that on a closing basis before I think it starts looking a lot better. But definitely really productive initial day here for SoFi to reclaim that $11.80, $12 support that it broke and get back above. So anyway, you sold some on the way up, and then you got stopped out of the rest at 1224. I'm assuming here. Maybe here. What are these lows? 1224. So you got stopped out here or here. It's always helpful if you can throw your times in to help us with our analysis of your trade too. But in one of those two spots, which is fine. You know, you were trailing on a 5, maybe even a 15-minute chart, and it rolled over a little bit there, and you got pushed out. Definitely a great hold on the remainder of your stock. Should I have sold to cover risk even though it's just trailing the ADMA? Oh, yes. I mean, you mean that first sale of half of your stock? Absolutely. Especially on a counter trend trade like this in the stock that's super beaten up. You got to get your risk covered. When you're trading counter trend, it is so important to get your risk covered counter trend. And I don't care. We can't just look at, you know, the market went up so big from where I sold some stock. For every time that happens, there's going to be a dozen others where you're trading counter trend, where the stock barely lets you cover your risk, and then the trade goes and fails, because inherently counter trend trades are designed to fail given a long enough time horizon. How do you manage your add backs if it never gets low enough to add back? Then I don't add back. You know, the thing about a lot of what I'm doing where I'm adding back stock is that I had sold such a small percentage of a core position that if I don't get the stock back, I don't really care. It's not the end of the world to me. I'm still heavy enough to make really good money if it continues, but still willing to take the cash flow on booking some to some extension and rebuying it and kind of having those add back type situations. From Bill here, what's your personal opinion on the saying, as January goes, so goes the year? When it comes to any of the trader sayings or any of the stuff that happens just typically, typically January is a pretty good year for the market. Typically January has the January effect, right? Typically there's a Santa Claus rally. Typically you sell in May and go away. You know, all that stuff is typical. But when I think about any trader's sayings, do I pay attention to them? Yes, because they were created for a reason. You know, most sell in May and go away. Summer months are usually pretty tricky months, right? Usually the trading's not as good, and a lot of times the market's weaker during that period of time, but not always. So I pay attention to all the sayings. I kind of store them in the back of my brain. I understand where we are. It honestly does make sense to me for this January to see kind of more of this type of price action as the year goes on. Maybe not the same degree of volatility, but, and it's not the first time I've said this, and it hasn't really happened since 2015. Why can't we have a year this year where the markets are just kind of volatile but sideways? You know? Why can't we have a year this year? I mean, the percentage returns over the course of the last couple of years have just been so huge. Why can't we have more of a average type of year, right? Why can't we have a year where the market closes between down 10% and up 10% on the year with a whole slew of volatility in between? That's what we saw back in 2015, which made for honestly a pretty difficult year. I remember it pretty well. It was one of the trickier years of trading years of my career. To me, that makes perfect sense. Like I just said before, we're going through a real adjustment here for markets where we got the fear of interest rate hikes, we got the idea that the economy is supposed to be able to take over. Maybe it can't. There's going to be this battle back and forth that takes place all year as the market adjusts to these interest rate increases. We don't know how many we're going to get. The market's pricing in 5 right now. Maybe we get 3. Maybe we get 7. Maybe it's a 50 basis point hike to lift us off in March. Maybe it's not. Maybe the economy does well enough to be able to thwart the negative impacts for the stock market of those interest rate hikes. Maybe it doesn't, but maybe it not doing that means that they don't hike as aggressively. There's a real scenario, I think, where all of the answers to these questions that we obviously can't know because we can't see into the future so perfectly, just lead to a year where we're very volatile and end up between up 10% and down 10% on the year, which would give us somewhat similar price action to what we've seen in January, albeit January was a little bit bearish. It was a lot of it bearish, right? It was almost the worst January ever for the NASDAQ. So, you know, again, I put all that stuff in my brain. I think about it. But, you know, I hope no one was betting their life on the January effect coming into play for this January either, because it certainly didn't play out, right? So we'll see, but I just think it could be very reasonable of a thought process. From Paul, technical question. When negating a negative Maribozu via inside 5, is the trade on the break of the inside 5 or when the Maribozu is fully negated? For example, DKNG at 940. Cool. Yeah. No, you would buy the and this is a great trend continuation setup here. This is exactly how I like them to come in. Strong initial opening that creates a high, pull back into equilibrium, and we've discussed 2 ways to enter these trend continuation trades. One is if you get a hammer continuation doji, that's not what you got here. One is if you have like a negative Maribozu followed by an inside bar and the inside bar breaks up. You trade the inside bar. You buy the break of the inside bar and your stop loss is the absolute low that was created at that point. Not necessarily the low of the inside bar, the absolute low, which would typically actually be the low of the negative Maribozu there, unless they were equal lows, in which case it's the same price. So that's how I would trade it, Paul. Great question there. Love it. Next from DJ. Do you ever move up your personal max loss if you hit certain P&L? This is a great question. If negative $200 was your max loss and you're up $200, would you move your max loss up to 0 or something like that? Or do you just kind of play each stock on its own and not think about it too much? DJ, I love the question. I love questions that are about money management because money management is the key to success in the trading business. Excuse me. What you're describing is what we call a limit up-down. All right, so let's just go over some broad risk numbers. If you're a professional prop trader with T3, you have something that's called a lockout. It's a system lockout. It's forced discipline brought to you by the system because you lost more money than you should. You don't ever want your system lockout to trigger, so what you should be doing is you should be giving yourself what we call a limit down. A limit down is a personal internal number that you are paying attention to that you should never exceed because you have your own discipline and you don't need the software to provide discipline for you. You don't ever want to be locked out of your system because you never know when a rare once-in-a-lifetime trade could actually hit because some major macro event happens, and if you're sitting there locked out, it could cost you a lot of money. So let's just make up some numbers. Let's say your lockout number is $500, so maybe your limit down number is $350 or $400. So those are your downside numbers. Next, we want to ensure that we're able to make money. So what I am not a believer in, is just stopping because you made a certain amount of money. So maybe your really bad day is losing $400 or $500. Maybe making $1,000 or $1,500 is a good day. So here you are, you find yourself up $1,000. You go, oh my God, this is great. You sell all your positions and you go for, I don't know, you go for a walk or something. I don't like that. because you will never have a $2,000 day if every single time you're up $1,000 you liquidate all your positions and you call it. I'm a big believer, whether it's an individual trade or whether it's a sum of trades that include an entire day, I'm a big believer in limiting your downside and leaving your upside as unlimited as possible. That's why we have trailing stops on our trades. Similar, you can give yourself a sort of trailing stop on your P&L. This is what we call a limit up down. So if being up $1,000 is a great day for you, and part of you wants to just close it out, don't, because you'll never turn a $1,000 day into a $2,000 day. Give yourself a limit up down. The question is, how much of the $1,000 are you up are you willing to risk in order to make more? Maybe it's $500. In which case now you make it so that your worst case scenario is going home with $500. Is going home with $500 as good as going home with $1,000? No, it's not. Are you going to be happy if you were up $1,000 and you go home with just $500? No, you're probably not. But if you think about this in terms of money management in the long run, this is going to be what is key to driving overall profitability at the end of a month or at the end of a year. You stop yourself at being up $500 if things are not working out well, but maybe that extra $500 in risk that you gave yourself enables you to turn a $1,000 day into a $2,000 day, a $2,000 day into a $5,000 day, a $5,000 day into a $10,000 day. That's what we want. So yeah, big believer in that. One area though that's a little bit tricky is that it's not the P&L on the top of your screen that you're doing this based on. You need to do it based on your worst case scenario. Because if you're up $1,000 in the day, but you still got $700 worth of risk on, if all your trailing stops roll over and trigger you and stop you out, you're only up $300. It means that you're really only up $300. So you can't just give yourself that limit up down based on what your screen is telling you. The limit up down needs to be a number that comes in after you've calculated your worst case scenario based on the positions that you still have open. Thank you for the question, DJ. Next here from our buddy Sebastian. Was looking at bros. What's up, bro? Was looking at bros above yesterday's high of the day. Okay, a little pivot. I wouldn't consider that pivot to be too important. I missed the breakout. Yeah, I wouldn't even really... The level seems to be more like 50, though I would also argue that it's sloppy because you see these tails here that have come above it. But okay. You wanted to get involved in a pullback after you missed the break of yesterday's high, but you didn't really want to buy it on the way down, so I love that. So I waited for a signal, and even though I got a hammer, the next candle kept going down at first, and I ended up missing the opportunity. Here's where it broke. I'm assuming this is where your little hammer kind of is. Yeah, so you need to be buying on the way up here, on the way up off this candle's low. That's really your setup. It's not super clean. It's not like it's a perfect hammer here. But going back to Paul's question earlier about the two ways for trend continuation, one is the inside and up off the negative Marubozu inside and up, and one is your hammer doji ideally off the equilibrium area. This is not perfect, but it's closer to that second one. So that's what you need to find. You need to find another. Basically, if you miss your breakout, and first of all, the first answer to the question is don't miss your original trade. Let me start by that. The second part is then you need to find another setup, and another setup could look like a CHPT. This momentum rest continuation. It could look like Kanji. Yeah, it could look like this for trend continuation, or, and again, not a perfect one, it could look something like this, a doji into that 80 EMA on the small time frame looking for trend continuation. So you need another setup. And if the other setup doesn't come, then you miss the trade, and it just is what it is. Does anyone have a good template for setting up macro keys? I don't know what macro keys are. If you mean hotkeys, reach out to Pat. Reach out to Pat. Pat should be able to help. And wow, looks like we banged through those questions. Okay, cool. So it's almost 5 o'clock, so I'm happy to end the meeting here. We had some really good questions, and we had a really good trading setup day today. You know, we were super on point with stuff. Perfect technical follow through. I think tomorrow's going to be a little bit trickier. I'm really hoping for a gap up tomorrow, so I can start looking for maybe some hedging type shorts. But we'll see. We'll see. See everybody tomorrow. Have a great evening.